My next guest believes the U.S. solar market will likely disappoint many of the most optimistic forecasts being provided by both Chinese and European solar companies. Joining us now, Gordon Johnson of Axiom Capital Management. Also have with us Jack Hidary. He's the chairman and chief executive of Samba Energy. Jack, of course, just back from China. Gordon, give us your take on what's going on in the solar industry. We were just talking briefly about Solyndra and the Department of Energy loan guarantees. Jack says that it has a lot to do with the kind of technology that Solyndra employed.
Yeah, I think essentially with Solyndra, like Jack was saying, it all boils down to their cost. Their cost was about $250 a watt. They were a thin film manufacturer, and the competing technology, First Solar, at the time was about 85 to 80 cents a watt. So they were dead on arrival. I mean, anyone who knew solar.
So why would they do this? I mean, why would a business plan even get to the stage of talking about building a second manufacturing facility if, as you described, the math just doesn't work?
Because I don't think politicians understand solar technology. I think that's what it boils down to. It was a very interesting and innovative technology, but at the end of the day, solar is a commodity. And when you talk to these companies, every company has their own pitch or their own angle to make it seem as such that it isn't, but it's a commodity. So if your costs are significantly higher than the rest of the competition, nobody's going to buy your product.
Jack Hidary?
Exactly. What China did, they realized that solar energy, solar power is not some oddball thing. It's actually just consumer electronics. It's a piece of glass with chemicals on it and some electricity. That's called a TV, a flat panel TV. So they've applied the same supply chain optimization that they applied to the LED TV market now to the solar market.
Flip the switch, turn the factory on, and keep it rolling along.
But here's the good news. The good news is that while a lot of the U.S. solar manufacturers, I think, are going to have a very, very tough headwinds right now, there's companies like Solar City that are not yet public, but thinking about public offerings, maybe in a year, maybe in 2 years. These are on the installation side, the downstream side of solar. They're benefiting from the low prices, not being hurt by the low prices.
All right, but Gordon, installation, all right, that presupposes that the actual cost of the electricity is what? Going to be subsidized by somebody somewhere?
It has to be subsidized. I mean, solar is exorbitantly more expensive than any other form of electricity. And from an installation perspective, just yesterday, GCL, who's a major polysilicon and wafer manufacturer in China, their COO was in town. And they said their cost to make a module today, this is a module, their cost to make a module today is 76 cents going down to, 79 cents going down to 76 cents by the end of this year. The lowest cost guy in the market right now, First Solar, is at 75 cents, but they make thin film panels versus crystalline silicon. So they're far less efficient than crystalline silicon, First Solar's panels, so you have to sell at a big discount to make up for the difference. So the point is, GCL, who's making the poly in China, they have the low costs. They can come in and undercut guys like Solar City, Phoenix Solar. If they want to, they can dominate the market in the U.S. And when you talk to the energy producers or the investors in solar projects like NRG, they'll tell you, we're agnostic to the technology. We just simply care about cost. So I think the Chinese are going to dominate. But even in China, there's overcapacity.
Tell me about what's going on with subsidies, because you've got to have a subsidy, as you describe it, in some form or another to make the actual electricity production competitive.
Exactly. You need a subsidy because solar is about 3 to 4 times more expensive than fossil fuel-based electricity, what we're paying out of the socket. Now, what's happened with subsidies, and the reason why these stocks are trading off significantly, is subsidies have been cut in the 2 biggest markets, Germany and Italy, as well as all the other European, pretty much everywhere, subsidies have been cut. So subsidies cut, demand down. Meanwhile, supply is growing. By our estimates, roughly 90% this year. So it's simple supply-demand economics. And prices in commodity markets, when you have oversupply, go to marginal costs. We're nowhere near marginal costs. So I think there's further price downside, and thus I think the stocks will get hit further.
Jack Hidary, falling prices and fewer subsidies. Germany's out of money. Italy's out of money. What about U.S. subsidies? You think that's going to come to the rescue?
Well, we have about 3,000 different incentives in the U.S., so we have a lot of different subsidies here compared to Germany and Italy, because we have state and city and utility and federal as well. What's interesting is to look at a dichotomy between utility scale solar that has to compete with wholesale energy prices and end user rooftop solar, which has to compete with much higher retail prices of electricity. I think that we're going to see a big rise in rooftop compared to utility scale because it has to compete with something that's much higher and easier to compete with.
All right, but that means still means subsidies, right?
Some subsidies in the near term. Over the long term, I think they're going away.
All right, we got to leave it there, gentlemen. Thank you very much. Jack Hidary joining us from Samba Energy. Always appreciate it. Gordon Johnson from Axiom Capital Management. Keep your eye on solar for us. Thank you very much.